Welcome back, it's me Adam and you're watching Unlimited Options Investing. In this video, we're going to be talking about what it's going to take in order for markets to rebound, both stocks and crypto alike. Essentially, Jerome Powell and the Fed, right now they're tightening financial conditions by increasing interest rates. We just saw a few weeks ago the Fed increased rates by 0.75%, something we haven't seen since 1994. We're having decades high inflation from the last 40 years before I was born. So what is it going to take in order for the Fed to pivot? And I'm going to tell you exactly in this video. All right, so the first order of business, in order for markets to rebound and for the Fed to pivot, enough tears have to be shed. Okay, I'm just kidding. I don't think I could cry any more than we already have. But the first order of business really is, for example, the COVID zero strategy in China. Essentially, since the beginning of the pandemic, China has been very, very strict, whereas in the US, we know that state by state, it's been different depending on each state's legislation and whether they're Democratic or whether they're Republican. But in China, they take it extremely serious. Even in Shanghai, they've been locking down, for example, Tesla and their Shanghai plant. They haven't been able to produce as many vehicles because it has been shut down for a significant amount of time. And this is the kind of thing where I can see one time you look at your phone, all of a sudden you see CNBC breaking news, China no longer implementing COVID zero strategy. And just on that news, I could see the market rallying significantly. Now, I don't know, I can't predict the future. I don't know how much it would rally or if it would be enough to break the downtrend that we've been seeing for the better part, the entirety of 2022 and the peak of the NASDAQ in November of 2021. But it would definitely have a huge effect on supply chains because China is a very important global exporter of goods. And this reminds me of back in November of 2020. So just to take you guys back, so the market bottomed back in March of 2020. We had that V recovery into the summer of 2020. The fall, we had a little bit of a correction. And then November 6th, I want to say, of 2020, we got the news that Pfizer came out with their vaccine. And then shortly thereafter, Moderna. And the market rallied huge. It gapped up and then never saw those lows until this year, pretty much. And similar to a breaking news story, something else that markets would love, that the world would love this really, but specifically about markets, is the war and the invasion in Ukraine finally coming to an end. Now, I have no idea if it's going to, again, similar to the China thing, we don't know if it's happening this week or if it's going to happen in years from now. But eventually, you get CNBC breaking news, Russia and Ukraine have started talks in a truce or whatever it may be. Again, I could see the market really, really liking that. It would take a lot of pressure off of inflation, and again, therefore taking a lot of pressure off of the Fed from having to increase interest rates, and it's just a domino effect from that point. But unfortunately, as flawed as humans as we are, it doesn't look like that thirst for power is going to be taming down anytime soon. So until we get some kind of news, again, similar to the COVID zero strategy finally finishing, we're still going to have those pressures on inflation. Specifically, with the invasion comes the price of oil. I think there's a lot of speculation on the fear that oil is going to continue rising, which is why I think oil is so elevated these days. So right now, the price of oil is about $100 per barrel. We reached a peak back in March of about $130 per barrel. And just as recent as a few weeks ago, we were $120 per barrel. So I don't know what price we're going to be once the war does end, but assuming it's still elevated, and by elevated, I mean above maybe probably $80 per barrel. I don't know how much that price is going to come down, but I do see a significant decrease in speculation, assuming the demand is still there. Which leads me to my third point, is just demand getting crushed to the point where the supply is over here, demand is over here right now, to the point where interest rates keep rising and the demand eventually meets the supply, or to a point where the Fed is happy that they don't have to be increasing the interest rates as aggressively as they have been. So over the past 2 years, we've seen an incredible amount of pent-up demand into the market, whereas supply just hasn't been able to catch up, again, for a plethora of different reasons. Typically, high demand isn't necessarily a bad thing, assuming that the supply can catch up. However, again, because of all the craziness that's been happening around the world, supply hasn't been able to keep up. Therefore, it's just been a red-hot market, and that's no good for inflation because the more dollars there are in the system, the more dollars are chasing for those goods and services. Hence, all the inflation we've been seeing. Therefore, the Fed has been trying to increase rates to cool down that demand to meet that supply. The issue with that is if you cool down demand, you might tip yourself into a recession, which may very well be what's about to happen. Which leads me to my last point, that demand is destroyed to the point where it catches up to supply, to either equilibrium or to a point where the Fed is comfortable no longer increasing rates so aggressively, or dare I say even cut rates to go back down. But we have to see how things play out, and then based on how things play out, how the Fed perceives those things happen. At that point, things could tip into a recession if we currently aren't in one right now. Prices of assets coming down. At that point, you need income, whether you're actively going to work or passive income. You need something to sustain yourself during a down period until that economic cycle resets, and then we eventually see good times again. So those are three different things that could happen. I mean, only one of them could happen and we might be okay. Maybe two of them, or maybe all three need to happen in order for us to see good times again, and for markets to eventually rebound and eventually see those highs that we once saw last year. Otherwise, that is the end of my video. Thank you very much for watching. As always, let me know in the comments below what are your thoughts, and I'll see you guys in my next video.